Question 1. Topic: Annuity riders. Cost of riders and their impact on annuity performance. Ellen has purchased a deferred annuity with a guaranteed lifetime withdrawal biennial double ride. She is concerned about the fees associated with this rider and how they might affect her annuity's performance over time. Which of the following best describes how the cost of this rider could impact Ellen's annuity? A. The GLWB rider fees are deducted from the guaranteed withdrawal amount, meaning Ellen's actual payments will be reduced by these fees. B. The GLWB rider fees are taken from the annuity's cash value, potentially reducing its overall growth and impacting future guaranteed withdrawals. C. GLWB fees are applied to Ellen's premiums, increasing the cost of the annuity but having no effect on future benefits. D. The GLWB rider's fees are charged only if Ellen decides to exercise the rider, so they will not impact her annuity's performance until she takes withdrawals. Answer: B. The GLWB rider fees are taken from the annuity's cash value, potentially reducing its overall growth and impacting future guaranteed withdrawals. Explanation: the cost of a guaranteed lifetime withdrawal biennial rider is typically deducted from the cash value of the annuity, impacting its growth over time. This reduction in cash value can lead to decreased performance of the annuity, as ongoing fees reduce the amount of money available to accumulate interest or investment gains. Since GLWB fees are taken from the account regardless of whether Ellen exercises her withdrawal options, her overall cash value and potential benefits might be diminished. Virginia law mandates clear disclosures regarding the costs and impact of riders, requiring insurers to inform clients of how these fees might affect future annuity performance. This regulation aims to help clients like Ellen make informed decisions about purchasing riders with fees that can erode the long-term growth of their annuity. Question 2. Topic: Variable annuities. Mortality and expense charges. Which of the following statements is correct regarding the mortality and expense ME charges in a variable annuity? A. ME charges are added to the annuity's investment value and grow with the account balance over time. B. ME charges are primarily for covering administrative costs and have no effect on death benefits. C. ME charges are deducted as a percentage of the annuity's account value, reducing the total value of the account balance each year. D. ME charges are one-time fees deducted at the beginning of the contract and do not recur annually. Answer: C. ME charges are deducted as a percentage of the annuity's account value, reducing the total value of the account balance each year. Explanation: mortality and expense ME charges are ongoing fees deducted as a percentage of the account's value each year in a variable annuity. These charges are intended to cover insurance risks, such as the cost of the death benefit and other administrative expenses. Unlike other one-time or fixed charges, ME charges can increase in absolute terms as the account grows, given that they are based on a percentage of the account's balance. Virginia regulations stipulate that insurance companies must provide transparent fee disclosures explaining how ME fees will impact the annuity over time. This ensures clients understand that these fees will continuously reduce the account balance, affecting both the cash value and potential payouts. By reducing the account value, ME charges may indirectly reduce the death benefit and other performance-based benefits associated with the annuity. Question 3. Scenario-based. Topic: Taxation of annuities. Tax-deferred growth and earnings. Mr. Lee, age 52, invested in a non-qualified deferred annuity that he has held for 10 years. Recently, he decided to withdraw a portion of the accumulated earnings to cover medical expenses. What tax implications will Mr. Lee likely face for this withdrawal? A. Mr. Lee's withdrawal will be subject to income tax on the earnings portion only, and since he is over 50, there is no penalty for early withdrawal. B. Mr. Lee's withdrawal will be taxed as ordinary income on the earnings portion, and he will incur a 10% early withdrawal penalty on the taxable amount since he is under 591 WO. C. Mr. Lee can withdraw earnings from his annuity without paying taxes if he uses the funds for medical expenses. D. Mr. Lee's withdrawal will be completely tax-free as the annuity has been held for more than 5 years. Answer: B. Mr. Lee's withdrawal will be taxed as ordinary income on the earnings portion, and he will incur a 10% early withdrawal penalty on the taxable amount since he is under 591 WO. Explanation: for non-qualified deferred annuities, the growth within the annuity is tax-deferred, meaning that earnings are not taxed until they are withdrawn. When Mr. Lee withdraws his earnings, they will be taxed as ordinary income. Because Mr. Lee is under the age of 591, the IRS imposes an additional 10% early withdrawal penalty on the taxable amount unless an exception applies, such as disability or qualified medical expenses exceeding a certain threshold. Virginia regulations align with federal tax laws regarding the taxation of annuities, reinforcing the importance of understanding penalties and tax consequences for early withdrawals from non-qualified annuities. Its structure encourages annuity holders to defer withdrawals to maximize the tax advantages provided by annuity investments. Question 4. Topic: Fixed annuities. Interest rate determination and guarantees. In a fixed annuity, which of the following is true regarding the interest rate guarantees provided to the annuitant? A. The interest rate is guaranteed for the life of the contract and cannot change regardless of market conditions. B. Fixed annuities provide a guaranteed minimum interest rate, though the actual credited rate may be higher depending on market conditions. C. The interest rate is guaranteed to match inflation each year, ensuring the purchasing power of the annuitant remains constant. D. Fixed annuities offer a variable interest rate that is adjusted monthly based on the annuity's performance. Answer: B. Fixed annuities provide a guaranteed minimum interest rate, though the actual credited rate may be higher depending on market conditions. Explanation: in fixed annuities, insurers guarantee a minimum interest rate that will be credited to the account regardless of market performance. This rate, set at the time the annuity is issued, ensures that the annuitant receives a minimum level of growth. However, insurers may offer higher rates than the minimum, often based on prevailing interest rates or market conditions, though these are subject to change within the contract's terms. Virginia regulations require transparency in interest rate guarantees, ensuring annuitants understand that while their principal and minimum growth are secured, actual credited rates can vary above the guaranteed minimum depending on economic factors. Question 5. Topic: Taxation of annuities. Early withdrawal penalties and exception as ERS penalties. An individual age 45 decides to make an early withdrawal from a non-qualified annuity to help pay for a new home. What penalty and tax implications might they face for this withdrawal? A. They will incur 10% early withdrawal penalty on the earnings portion and no ordinary income tax on the entire withdrawal amount. B. They will incur no penalties if the funds are used toward a primary residence but will owe ordinary income tax on the earnings. C. The withdrawal will be tax-free since it is intended for a qualified purpose, but a 10% penalty on the earnings portion still applies. D. They will incur 10% early withdrawal penalty on the earnings portion and owe ordinary income tax only on the taxable earnings withdrawn. Answer: D. They will incur 10% early withdrawal penalty on the earnings portion and owe ordinary income tax only on the taxable earnings withdrawn. Explanation: for non-qualified annuities, IRS regulations impose a 10% penalty on the earnings portion of early withdrawals made before age 591 unless an exception applies. Additionally, the earnings are subject to ordinary income tax. Using the funds for a primary residence is not an exception to the penalty for annuities, as it might be with other types of retirement accounts. Virginia aligns with federal IRS rules for penalty structures, ensuring that annuity holders understand these penalties to prevent unintended tax consequences. This rule highlights the importance of holding annuities as long-term investments to fully realize their tax-deferred advantages. Question 6. Scenario-based. Topic: Annuity suitability and needs analysis. Risk tolerance and investment horizon. Mr. Ramos, age 60, is considering investing in a variable annuity to grow his retirement funds. He mentions that he would like the potential for growth, but wants to minimize risk since he plans to retire in 5 years. Based on his profile, what type of investment strategy might be suitable within a variable annuity? A. Investing in high-growth equity sub-accounts for maximum growth potential. B. Allocating funds into a balanced portfolio with both equity and bond sub-accounts to diversify risk. C. Choosing only fixed income sub-accounts to completely eliminate market risk. D. Investing solely in international sub-accounts for higher potential returns given the shorter time horizon. Answer: B. Allocating funds into a balanced portfolio with both equity and bond sub-accounts to diversify risk. Explanation: given Mr. Ramos's desire for growth with minimal risk in his 5-year retirement horizon, a balanced portfolio within a variable annuity is a suitable approach. This strategy diversifies his investments across equities and bonds, providing moderate growth potential while reducing exposure to the volatility of a fully equity-based approach. Virginia suitability standards require that annuity recommendations match the client's risk tolerance, financial goals, and time horizon, emphasizing a balanced investment for individuals nearing retirement with low-risk preferences. This guidance helps ensure that Mr. Ramos's annuity aligns with his retirement goals without exposing him to undue market risk. Question 7. Topic: Indexed annuities. Crediting methods. Annual reset, point-to-point, high-water mark. Which crediting method in indexed annuities locks in interest based on the highest point the index reaches during the term, offering protection against index declines? A. Annual reset. B. High-water mark. C. Point-to-point. D. Averaging method. Answer: B. High-water mark. Explanation: the high-water mark crediting method in indexed annuities captures the highest value the index reaches during a term and uses that to calculate the credited interest. This method offers potential benefits by allowing interest to be credited based on the maximum performance even if the index later declines. Annual reset and point-to-point methods differ in how they determine credited interest, with annual reset locking in gains each year and point-to-point measuring index growth over the entire term. Virginia's annuity regulations require clear explanations of these crediting methods to help clients choose a structure that aligns with their investment preferences and risk tolerance, especially as indexed annuities have varied interest crediting options. Question 8. Topic: Annuity contracts and policy provisions. Free look period and right to cancel. In Virginia, what is the primary purpose of the free look period in an annuity contract? A. To allow the annuitant to withdraw funds without penalties during the first few months of the contract. B. To enable the annuitant to cancel the annuity contract for any reason and receive a full refund of premiums paid within a specific period. C. To provide a period for changing beneficiaries without any administrative fees. D. To allow the insurance company to make adjustments to the annuity terms if market conditions change. Answer: B. To enable the annuitant to cancel the annuity contract for any reason and receive a full refund of premiums paid within a specific period. Explanation: the free look period in Virginia allows annuity purchasers a specific window, typically 3 days, depending on the insurer, to review the annuity contract, cancel it if desired, and receive a full refund of any premiums paid. This period gives the annuitant time to assess the contract's suitability and alignment with their financial goals. Virginia's Bureau of Insurance mandates this period as a consumer protection measure to prevent clients from being locked into a contract without adequate understanding. This regulation underscores Virginia's commitment to protecting consumers' rights and ensuring transparency in annuity contracts. Question 9. Topic: Regulation of annuities. Advertising standards and prohibited practices. Which of the following advertising practices is considered prohibited under Virginia's annuity regulations? A. Stating that an annuity offers tax-deferred growth potential. B. Implying that an annuity is guaranteed to double in value within 5 years. C. Describing the free look period as a right to review and reconsider your purchase. D. Stating that the annuity offers a choice of payout options at retirement. Answer: B. Implying that an annuity is guaranteed to double in value within 5 years. Explanation: under Virginia's regulations, advertising practices must be accurate, transparent, and not misleading. Claiming that an annuity is guaranteed to double in value within 5 years is prohibited as it creates unrealistic expectations and may mislead consumers about the investment's risk and potential returns. Virginia's advertising standards emphasize that all marketing language should fairly represent the product's features, benefits, and limitations, helping consumers make informed decisions. Statements about tax-deferred growth or payout options are acceptable as they reflect standard annuity benefits, but guarantees of unrealistic growth violate ethical advertising standards in Virginia. Question 10. Topic: Annuity riders. Death benefit options. What is the primary purpose of a death benefit rider in an annuity contract? A. To provide a lump sum payment to the annuitant upon reaching a specified age. B. To ensure the beneficiaries receive at least the amount of the annuitant's original investment if the annuitant dies before depleting the annuity's value. C. To offer a higher interest rate on the annuity for a limited time after the annuitant's death. D. To eliminate or surrender charges for the annuitant's estate. Answer: B. To ensure the beneficiaries receive at least the amount of the annuitant's original investment if the annuitant dies before depleting the annuity's value. Explanation: a death benefit rider is designed to protect the annuitant's beneficiaries by guaranteeing that they will receive at least the total amount of the annuitant's original premium or the contract's current value at the time of death, whichever is higher. Virginia regulations require insurers to clearly outline death benefit provisions, helping annuity owners understand the financial protections available for their beneficiaries and allowing beneficiaries to access the annuity's remaining value without penalties. Question 11. Topic: Annuity fees. Surrender charges. Which of the following statements is true about surrender charges in a deferred annuity? A. Surrender charges apply only in the first year of the annuity contract. B. Surrender charges decrease over time and eventually may be eliminated if the annuitant holds the contract long enough. C. Surrender charges remain constant throughout the life of the contract. D. Surrender charges increase if the annuitant takes out partial withdrawals. Answer: B. Surrender charges decrease over time and eventually may be eliminated if the annuitant holds the contract long enough. Explanation: in most deferred annuities, surrender charges are levied when an annuitant withdraws funds early, but these charges typically reduce each year until they disappear after a specified period. Virginia's regulations ensure that annuity providers disclose the surrender schedule and fees, allowing consumers to fully understand the long-term commitment involved with deferred annuities and helping them make informed withdrawal decisions based on the remaining surrender period. Question 12. Topic: Annuity payout options. Life annuity with period certain. If an annuitant selects a life annuity with a 10-year period certain, what happens if they pass away 5 years after the annuity payments begin? A. All payments stop upon the annuitant's death. B. Payments will continue to the beneficiary for the remaining 5 years. C. The beneficiary will receive a lump sum payment equal to 5 years of annuity payments. D. Payments will continue to the beneficiary for the rest of the beneficiary's life. Answer: B. Payments will continue to the beneficiary for the remaining 5 years. Explanation: a life annuity with a period certain ensures that payments continue for a specified period even if the annuitant dies before the period ends. If the annuitant passes away within the 10-year period certain, payments continue to a designated beneficiary for the remainder of that period. Virginia's annuity regulations require providers to clarify payout options, such as period certain, to help annuitants plan for their and their beneficiaries' future financial needs. Question 13. Topic: Suitability standards in annuity sales. Risk assessment. When assessing an applicant's suitability for an annuity, which factor would be most relevant to consider? A. The applicant's current employment status. B. The applicant's desire for short-term gains. C. The applicant's tolerance for financial risk. D. The applicant's hobbies and interests. Answer: C. The applicant's tolerance for financial risk. Explanation: an applicant's risk tolerance is crucial when assessing the suitability of an annuity because it affects the type of annuity recommended, e.g., fixed, variable, or indexed. Virginia's suitability standards emphasize that agents must consider the applicant's risk tolerance to ensure that the chosen annuity aligns with the applicant's financial goals and risk profile, avoiding investments that could expose the applicant to more risk than they are comfortable with. Question 14. Topic: Taxation of qualified annuities. Required minimum distribution, or MDS. At what age must individuals typically begin taking required minimum distribution, or MDS, from a qualified annuity? A. 591. B. 65. C. 72. D. 75. Answer: C. 72. Explanation: the IRS mandates that individuals with qualified annuities begin taking required minimum distribution, or MDS, by age 72. RMES ensure that tax-deferred funds are eventually subject to taxation. Virginia's annuity regulations follow federal tax rules, so annuity holders in Virginia must also begin RMDS by age 72 to avoid IRS penalties. Question 15. Topic: Variable annuities. Market risk exposure. Which of the following is true about market risk in variable annuities? A. Market risk is eliminated because the principal is guaranteed. B. Market risk affects only the fixed interest subaccounts. C. The value of the annuity may fluctuate with changes in the underlying investment options. D. Market risk applies only if the annuitant is under age 591. Answer: C. The value of the annuity may fluctuate with changes in the underlying investment options. Explanation: variable annuities involve market risk because their value is linked to underlying investments such as stock or bond subaccounts. If the market value of these investments changes, the value of the annuity can increase or decrease. Virginia's annuity disclosure requirements mandate that annuity sellers explain market risk to potential buyers, especially for variable annuities where the principal is not guaranteed. Question 16. Topic: Taxation and non-qualified annuities and withdrawals. Which part of a withdrawal from a non-qualified annuity is typically subject to income tax? A. Only the original investment principal. B. Only the earnings portion. C. both the principal and the earnings portion. D. None of the withdrawal is subject to tax. Answer B. Only the earnings portion. Explanation. For non-qualified annuities, only the earnings are subject to income tax upon withdrawal, as the original investment principal is made with after-tax dollars. Virginia follows federal tax rules for annuities, so understanding the tax treatment of non-qualified annuities helps investors make informed decisions on withdrawal timing. Question 17. Topic: Annuity suitability. Income needs in retirement. An individual nearing retirement expresses a need for a steady and predictable income stream. Which type of annuity might be most suitable for them? A. Variable annuity. B. Fixed annuity. C. Immediate annuity with equity sub-accounts. D. Deferred annuity with an income rider. Answer B. Fixed annuity. Explanation. A fixed annuity is often recommended for individuals seeking predictable income, as it offers guaranteed payments regardless of market fluctuations. Virginia's suitability regulations require agents to assess the annuitant's income needs and recommend products accordingly, ensuring that annuity recommendations match the financial goals of individuals nearing retirement. Question 18. Topic: Policy provisions. Annuity waiver of premium. What is the purpose of a waiver of premium rider in an annuity contract? A. To waive surrender charges on early withdrawals. B. To provide a death benefit to the annuitant's beneficiaries. C. To waive premium payments if the annuitant becomes disabled. D. To increase the interest rate during the first year. Answer C. To waive premium payments if the annuitant becomes disabled. Explanation. A waiver of premium rider allows the annuitant to stop making premium payments if they become disabled, helping them maintain the annuity's benefits without financial strain. Virginia's regulations require clear disclosures for riders like the waiver of premium, ensuring that annuitants understand the added protections they can receive through optional riders. Question 19. Topic: Indexed annuities. Cap rates. Which statement best describes the cap rate in an indexed annuity? A. It is the minimum guaranteed rate credited to the account annually. B. It limits the maximum interest that can be credited to the annuity based on the index's performance. C. It guarantees a fixed rate of return regardless of index performance. D. It determines the surrender charges for early withdrawals. Answer B. It limits the maximum interest that can be credited to the annuity based on the index's performance. Explanation. The cap rate in an indexed annuity is the upper limit on the interest credited based on the index's performance during a given period. Virginia's regulations on indexed annuities ensure that consumers understand how cap rates, participation rates, and spreads can affect potential earnings, helping them make informed decisions based on realistic expectations. Question 20. Topic: Payout options. Joint life annuity. In a joint life annuity, what happens to the payments when the first annuitant passes away? A. Payments stop immediately upon the first annuitant's death. B. Payments continue for the surviving annuitant's life. C. Payments increase for the surviving annuitant. D. Payments transfer to the estate of the first annuitant. Answer B. Payments continue for the surviving annuitant's life. Explanation. In a joint life annuity, payments are structured to continue for the lifetime of both annuitants. When the first annuitant passes away, the surviving annuitant continues receiving payments for the remainder of their life. This feature is valuable for couples who rely on a steady income, ensuring that the surviving spouse or partner will still receive income even after one person has passed. Virginia's regulations require that insurers fully disclose the terms of joint life annuities, including how payments are handled after one annuitant's death, so customers can make informed choices that align with their financial planning needs. Question 21. Topic: Indexed annuities. Participation rate. What is the participation rate in an indexed annuity? A. The percentage of premium used for administrative fees. B. The percentage of the index's gains credited to the annuity. C. The minimum guaranteed return on the annuity. D. The maximum loss the annuitant can incur. Answer B. The percentage of the index's gains credited to the annuity. Explanation. The participation rate in an indexed annuity determines what portion of the index's gains will be credited to the annuity. For example, if the index rises by 10% and the annuity has an 80% participation rate, 8% would be credited to the annuity, 10% x 80%. Virginia requires clear disclosures on participation rates so that annuitants can understand how these rates affect potential earnings based on index performance. Question 22. Topic: Annuity withdrawals. 10% penalty on early withdrawals. Which of the following situations would typically trigger a 10% federal tax penalty on an annuity withdrawal? A. Withdrawal made after the age of 591 WO. B. Withdrawal made to cover educational expenses. C. Withdrawal made before the age of 591 WO. D. Withdrawal made due to disability. Answer: C. Withdrawal made before the age of 591 WO. Explanation: the IRS imposes a 10% penalty on annuity withdrawals made before the age of 591 WO in addition to regular income tax on the earnings portion of the withdrawal. Exceptions may apply in cases of disability or other qualifying events. Virginia's annuity disclosures follow federal guidelines, helping annuitants understand the tax implications of early withdrawals and encouraging them to consider their long-term financial needs. Question 23. Topic: Annuity types. Immediate versus deferred annuities. What distinguishes an immediate annuity from a deferred annuity? Immediate annuities begin payments immediately after lump sum premium is paid, while deferred annuities start payments at a future date. Immediate annuities offer higher returns, while deferred annuities have guaranteed minimum returns. Immediate annuities are only available to individuals over age 60, while deferred annuities are available to anyone. Immediate annuities are taxable, while deferred annuities are tax-free. Answer: A. Immediate annuities begin payments immediately after lump sum premium is paid, while deferred annuities start payments at a future date. Explanation: an immediate annuity starts making payments to the annuitant shortly after the premium is paid, making it ideal for individuals needing immediate income. In contrast, deferred annuities begin payments at a later date, allowing more time for funds to grow. Virginia regulations require that insurance providers clearly explain the differences between immediate and deferred annuities to help consumers select products that meet their financial timelines. Question 24. Topic: Annuity payouts. Fixed amount versus fixed period. In a fixed period annuity payout, what happens to payments after the specified period ends? A. Payments continue as long as the annuitant is alive. B. Payments stop even if the annuitant is still alive. C. Payments increase at the end of the period. D. Payments are recalculated based on current interest rates. Answer: B. Payments stop even if the annuitant is still alive. Explanation: a fixed period annuity payout provides income for a specified time, e.g. 10 years, after which payments cease. If the annuitant is still alive at the end of this period, no further payments are made. Virginia's regulations on annuities mandate transparency in payout terms, ensuring that consumers understand how long they can expect to receive income from their annuity and any limitations associated with a fixed period payout option. Question 25. Topic: Tax-deferred growth. Advantages of annuities. Which of the following is a primary advantage of tax-deferred growth in annuities? A. It guarantees the principal amount against market loss. B. It allows the annuitant to earn interest without immediate tax liability on gains. C. It makes all withdrawals tax-free. D. It eliminates the need for the annuitant to file taxes. Answer: B. It allows the annuitant to earn interest without immediate tax liability on gains. Explanation: tax-deferred growth allows an annuity's earnings to accumulate without immediate taxation, with taxes only due upon withdrawal. This feature can benefit individuals seeking to maximize their investment growth over time. Virginia's annuity regulations ensure that consumers understand tax-deferred benefits and the potential tax implications upon withdrawal, making annuities a valuable option for long-term financial planning. Question 26. Topic: Suitability standards. Age and financial goals. Why is the annuitant's age an important consideration when assessing annuity suitability? A. Older annuitants automatically qualify for higher returns. B. Older annuitants generally have shorter investment horizons and may need more immediate income. C. Younger annuitants are eligible for lower fees. D. Age determines the annuitant's tax rate. Answer: B. Older annuitants generally have shorter investment horizons and may need more immediate income. Explanation: age is crucial in determining annuity suitability as it affects the annuitant's investment time horizon and income needs. Older annuitants might prefer immediate annuities or shorter-term payouts, while younger investors might consider deferred annuities to allow funds to grow over time. Virginia's suitability standards require agents to consider age to ensure recommendations align with the annuitant's financial goals. Question 27. Topic: Riders. Long-term care rider. How does a long-term care rider typically benefit an annuity owner? A. It waives all future annuity payments. B. It provides funds to cover qualified long-term care expenses. C. It increases the annuity's interest rate. D. It converts the annuity into a life insurance policy. Answer: B. It provides funds to cover qualified long-term care expenses. Explanation: a long-term care rider allows an annuity owner to access additional funds for long-term care needs, which can be especially valuable if the annuitant requires assistance with daily living activities. Virginia's regulations ensure that insurers disclose the terms and benefits of long-term care riders, allowing annuitants to prepare for potential health-related expenses while maintaining their annuity's value. Question 20. Topic: annuity taxation. Exclusion ratio. What does the exclusion ratio in a non-qualified annuity determine? A. The proportion of each annuity payment that is tax-free. B. The amount of penalties for early withdrawals. C. The interest rate applied to the annuity. D. The required minimum distribution. Answer: A. The proportion of each annuity payment that is tax-free. Explanation: in a non-qualified annuity, the exclusion ratio helps determine how much of each payment is a return of principal tax-free versus earnings taxable. This ratio is calculated based on the initial investment and expected returns. Virginia's disclosure regulations require that annuity providers explain the exclusion ratio to annuity holders to help them understand the tax implications of each payment. Question 29. Topic: indexed annuities. Spread rate. What is the purpose of a spread rate in an indexed annuity? A. To guarantee a minimum return regardless of index performance. B. To deduct a specific percentage from the index's gain before crediting the annuity. C. To set a limit on the maximum withdrawal amount. D. To determine the length of the surrender period. Answer: B. To deduct a specific percentage from the index's gain before crediting the annuity. Explanation: a spread rate is a percentage deducted from the index's gain in an indexed annuity, which affects the final credited interest. If the index earns 10% and there's a 2% spread, the credited gain is reduced to 8%. Virginia regulations require disclosure of spread rates so that consumers understand how these factors impact the actual returns of an indexed annuity. Question 30. Topic: annuity death benefit. Spousal continuation option in a non-qualified annuity. What does the spousal continuation option allow? A. The surviving spouse can continue the annuity without incurring tax penalties. B. The surviving spouse can convert the annuity into a life insurance policy. C. The surviving spouse must withdraw all funds immediately. D. The surviving spouse can reset the annuity's original purchase date. Answer: A. The surviving spouse could continue the annuity without incurring tax penalties. Explanation: the spousal continuation option allows the surviving spouse of an annuity owner to take over the annuity and continue receiving payments or defer them further, maintaining the tax-deferred status of the annuity. This provision is unique to non-qualified annuities and can be beneficial in estate planning as it enables the spouse to avoid immediate tax implications on the annuity's accumulated gains. Virginia's regulations mandate that insurers inform clients about the spousal continuation option, ensuring that spouses understand how they may manage the annuity upon the owner's death.